Hi everyone, today let us see what is the connection between business valuation and audited financial statements. A company maintains books of accounts and records, and all the transactions are recorded, assets and liabilities are reflecting, but whether a separate business valuation is required when the audited financials are available, that is the question we are going to address today. Of course, a business valuation is very much required when audited financials are available. Why? And many times we see that majority of the stakeholders believe that when audited financials are available, a value of the business can be directly arrived from that. Here, one must see that on what basis books of accounts are prepared, on what basis financial statements are prepared. Mainly, the books of accounts or financial statements are prepared on cost or historical basis method, following the standards IFRS and mostly on a conservative basis. But in real situation, the value of the business is totally different from a book value or net asset value of the business. Maybe for example, say the value of the business may be 10 times higher than the book value. The accountants are normally blamed off in this juncture or context. Why? Because after verifying and certifying, the book value of the company may not nowhere matching with the fair value of the business or market value of the business. Why? When you buy a product, you will see how much it really worth or how useful it is. In a real market situation, the potentiality of the business can be seen from a forward looking approach. How? When an investor entering into the business, he will naturally see how the business can earn in future, how much cash flow it can generate, how much potentiality the business can bring or the value addition it can create for the investor. In the same way, when one wants to sell a product, here the business or its share, the seller wants to get a maximum value or the real worth of the business he is going to hive off. The value of the business normally has to arrive from the returns it can bring in future, the earnings, the dividend or the capital appreciation. Unlike any product available in the market with its price tag, the value of the business cannot be easily or directly arrived from because it composes many assets, liabilities and all. And usually in the books of accounts, many items which are very material to the business are not recorded or not allowed to record. For example, customer rights, distribution rights, brand value and the employee skills or such assets which are intangibles are not allowed as per the standard accounting standards and all. The value of such intangibles, the cash flow such assets can bring in future are not usually valued or recorded in the books of accounts. Many times the book value or net asset value may be only a very small portion of the real value of the business, and hence the book value will hugely differ from the fair value or market value from an investor angle, and a separate business valuation exercise has to be carried out to make a fair or reasonable estimation of the value of the business. And that is why a separate business valuation is very much required even though an audited financials are available. We will be coming up with more informative videos regarding business valuation topics and all in the near future. Thank you.